the 6.5% is a threshold, not a trigger. In other words, when we get to that point, we will then at that point begin to look at whether an increase in rates is appropriate. And among the things we would take into account, first of all, is inflation. And inflation obviously is very low and expected to stay low. Secondly, we would be taking into account, does that unemployment rate fairly represent, in some sense, the state of the labor market? And as you pointed out, we have underemployment, part-time work, people leaving the labor force, reduced participation, long-term unemployment, a number of factors which suggest that maybe the 6.5% is a little bit not exactly representative of the state of the labor market at that point. So first of all, since it is a threshold and not a trigger, we are entirely free to take all that into account before we begin the process of raising rates. And that's what the diagram suggests. People are saying that unemployment will be at 6.5 in late 2014 or early 2015, but they're saying that increases in rates may not follow but several quarters after that. In terms of adjusting the threshold, I think that's something that might happen. If it did happen, it would be to lower it, I'm sure, not to raise it.